Welcome to the Thursday edition of Tech Stocks Daily. Get ready as we dive into today's tech stock roller coaster. First, we'll decode how Jamf Holding is playing tech chess with Apple and Microsoft, with juicy new collaborations and achievements. Then we'll peel back the layers of Apple's high-stakes drama, touching on Warren Buffett's curated chess match and some cloudy legal moves. Paylocity grabs our attention with insider trading signposts, revealing a world of finance intrigue. Finally, Microsoft's financial feast will serve you a baffling mix of good valuations and growth potential. Trust me, you won't want to miss this ride through the tech cosmos. Let's geek out and see if any of today's highlights have you calling your broker or buzzing in the comments. All right, tech enthusiasts, buckle up. Jamf Holding Corp, the company that's probably on your radar if you're all about Apple devices, has a bunch of updates. Let's break this down together with some humor and insights, shall we? First up, Jamf recently hit the news by announcing their presence at an upcoming investor conference, an event that tech investors will definitely want to keep on their radar. They'll be strutting their stuff, talking about all the Apple device management magic they bring to the corporate world. If you ever wondered how your company's iPhones are so seamlessly managed, Jamf's kind of like that unsung hero in the IT department, making it happen. They're like the Batman of Apple device management. The event will be streamed live so investors can cheer along from the comfort of their own offices. But wait, there's more. Jamf isn't just stopping at doling out details at conferences. They've also landed a significant achievement with Microsoft, attaining the coveted Microsoft Azure's IP co-sell top-tier partner status. This status, well, it's kind of like being given the keys to the city, but in the tech partnership world. It means that Microsoft and Jamf can buddy up to sell solutions to shared customers, diving deep into collaborations with some solid incentives to boot. And it gets better. Jamf has gone shopping, and now you can find their flagship device management solution, Jamf Pro, right there on the Azure Marketplace. For businesses already sporting a Microsoft framework, this is big news. We're talking sweet, seamless integration that feels like being told there's ice cream in the fridge and you can have it for breakfast. Companies can now procure Jamf solutions directly through the Azure environment, saving time and making the whole process as delightful as discovering a chocolate center in your favorite cake. That's not all. Jamf's keeping up with its impressive achievements by rolling out a plugin for Microsoft Copilot for security, fully ready for prime time. This development means Apple-focused security teams can now use Jamf to unlock next-level integration with Microsoft's intelligence tools. It's like giving Apple's intense security game a power boost, armed with the combined might of Jamf's device insight and Microsoft's smart security AI. Think of it as the Avengers of tech partnerships, where Apple and Microsoft only carry shields and secretive codes. This step not only shows off their enhanced threat detection for Apple devices, but also cements Jamf's long-running partnership with Microsoft that began way back in 2017. This collaboration is shaping the future by offering conditional access for macOS and other integrated tools ranging from Intune to Defender. And that's before you even factor in Power BI and Copilot. In short, Jamf has been making impressive waves with its strategic moves, enlarging its playing field with influential partnerships and integration in major tech marketplaces. It's clear that Jamf's keeping their eyes on the horizon, ensuring Apple environments everywhere in the corporate world remain as seamless, secure, and adaptable as ever. Keep an eye out because Jamf is not just in the news today, but is surely setting up shop in what's called the future. All right, folks, buckle up, because today we're diving into an Apple saga that's juicier than a freshly picked Granny Smith. Apple has been making quite a splash in the news recently, and for good reason. Let's unravel the fruity tales of the tech giant that everyone's talking about. First up, let's chat about Apple's stock performance and the intricate dance they're doing in the technology, hardware, storage, and peripherals industry. Apple, with its shiny gadgets and blockbuster design prowess, stands tall, yet a bit wobbly. Its stock seems to be priced like it's made out of gold and diamonds. The company sports a high price-to-earnings ratio, 37 times its earnings to be precise, which is a premium, or as my nana would say, fancier than a peacock at a turkey convention. Analysts are raising eyebrows as the stock seems overvalued compared to its industry peers. However, Apple is pulling solid profits, churning out a substantial $32.5 billion in EBITDA and holding a colossal gross profit of $43.88 billion. But what's leaving eyebrows scrunched tighter than a pair of extra snug AirPods is Apple's sluggish revenue growth. At just over 6%, it's far off the 167% industry average. Basically, the company needs to start sprinting unless it wants to be left trailing at the back with the floppy disk drives. Now onto something that could make even Shakespeare proud, a drama starring Warren Buffett. The Oracle of Omaha has been drenching Apple's parade by selling shares for the fourth consecutive quarter. Though his sales haven't exactly rocked Apple to its foundation like an energetic toddler's birthday party, investors should keep their eyes peeled. Surprisingly, our main takeaway isn't all drama. Buffett just wants to cool off with some cash and maybe dodge some tax rate hikes, sipping on a financial cocktail from his cash reserves, now over $325 billion. It doesn't sound like he's holding a grudge against Apple. He's perhaps just playing a seasoned game of chess as usual. We also have a bold move from the consumer advocacy group, which, planting a $3.8 billion legal claim slap on Apple's tablecloth. Accusations of breaching competition laws with iCloud look cloudier than a misty old London morning. The gripe? Allegedly restricting customers to the iCloud realm, offering few alternatives. With those extra fees for storage, things get pricier than ordering avocado on everything. And for an Apple, surprisingly sweet in the tail. If you hopped into a retro time machine and bought one lonely share of Apple at its 1980 IPO, you'd be sitting on 224 shares today, worth a cool $50,176. Look at that. Apple's past reveals the glittery potential tucked into long-term investing. So there you have it, folks, the polyphonic news of Apple swirling in clusters of industry analysis, billionaire antics, a slap of legal drama, and some more historical flair than you can shake a Macintosh at. Tomorrow should be just as fascinating, folks. So grab a crisp apple and stay tuned. Hey tech enthusiasts, today we've got quite a buzz around Paylocity Holding, as it's gotten some serious attention due to insider trading activities. No, it's not some scandal. This is the completely legal kind where insiders, primarily board members, are selling shares, and it's piqued interest in the finance world. First up, we've got Ronald V. Waters and Jeffrey T. Deal making headlines with their recent activities. Waters, a well-positioned board member at Paylocity, decided to part ways with 888 shares, translating to a cool $188,806. Next, Deal stepped up, making a splash by unwhopping 37,801 shares for a staggering $840. On top of that, he casually let go of another 4,017 shares worth $861,041. You know, just another day in the life of a high roller, it seems. What prompted this insider selling spree? Companies often require insiders like Waters and Deal to report such moves, bringing them to the market's attention and scrutiny. This offers investors valuable insights into what people at the top might be thinking. Insiders selling shares isn't necessarily a bad omen for company performance. People sell for a variety of personal reasons. Now, let's talk about Paylocity itself. It's a company that offers payroll and human capital management solutions, focusing particularly on small and mid-sized U.S. clients. Despite the insider sales, Paylocity's stock seems a bit static right now, opening up down by 0.% at $211.62, but the focus is more on what these insider transactions reveal about the company. Paylocity's financial report card has a bit of everything. Over the past 3 months, revenues have slipped by 12.5%, leading to some worry about its top-line earnings. These growth pangs are evident compared to rivals in the industrials sector who've pranced ahead with better figures. The gross margin seems solid at 68.5%, indicating decent profitability, but Paylocity's earnings per share of 0.62 hint that it's not quite hitting those bottom-line expectations. While the debt-to-equity ratio is commendably low at 0.34, showing cautious financial approaches, the stock's price-PE ratio of 63.0 places it in the overvalued haul for some. Same goes for its price-to-sales ratio of 8.91, which is relatively high for its industry contemporaries. And that snazzy EV/EBITDA ratio of 35.85, it's a sign this company might just be more valued than your average Joe in the sector. So why all the interest in those insider moves? It's not so much a panic button as it is a strategic insight. Readers, eyeballing these insider transactions can be a treasure trove when assessed alongside other financial indicators. While insiders' actions provide pieces of an investing puzzle, remember, they're just one part of a broader investment strategy. Will Ronald V. Waters and Jeffrey T. Deal's poker face of selling paint a picture of Paylocity's future prospects? Stay tuned for more data, insights, and as always, keep an eye out for your favorite tech stocks buzzing their way to the headlines. Hey tech enthusiasts, today we're diving into why Microsoft grabbed the spotlight with some buzzing financial insights that any tech investor or industry watcher won't want to miss. Microsoft is under the magnifying glass as comparisons against its peers shine a light on its position in the competitive software industry. So what's new with this tech titan? First up, let's talk numbers. Microsoft boasts a price-to-earnings ratio of 35.11, which is lower than the industry average, hinting at potential growth at what some might call a bargain price. This comparison acts like an enticing teaser for investors wondering if now might be the right time to jump on the Microsoft bandwagon. But before we start throwing confetti, there's more to consider. The price-to-book ratio stands at 10.99, again below industry norms, signaling potential undervaluation. Oh, the suspense. On the flip side, there's the price-to-sales ratio sitting higher than the average, which might make you scratch your head about its sales-driven valuation. Is it a sale worth making, or a ticket for a future bump? You decide. Keeping things juicy, Microsoft's return on equity trails behind its peers by 6.61%, hinting at an inefficiency puzzle that could be a red flag for some stakeholders. Do you smell what I smell? Yep, a potential investment mystery worth solving. However, stay seated because there's more to this roller coaster. Microsoft whips out a dazzling earnings before interest, taxes, depreciation, and amortization of $38.23 billion. Yep, you heard right, way above the industry average, signaling robust cash flow and profitability. Add to that a revenue growth rate of 16.04%, outshining its competitors. It's like watching Usain Bolt at a casual sprint meet. Anyone else feel like taking notes here? What beds all this beautifully? a debt-to-equity ratio comparison that rewinds any drama by highlighting Microsoft's solid standing against top competitors with a rock-bottom ratio of 0.21. Now that's bound to earn a collective ooh from investors worried about their financial health in turbulent times. In essence, Microsoft's latest deep dive into the financial rabbit hole paints a mixed yet intriguing picture. There's promise and room for optimism, but enough uncertainties to keep shareholders on their toes. Now that we've decoded the big tech moment du jour, what are we all thinking? Are you ringing the Microsoft bell, or do you hear a different drum? Dive into the comments section and let me know how tempted you're feeling to revamp your tech stock selections. Do these insights have you overeagerly pinging your broker, or cautiously tapping that add to watch list button? Can't wait to hear your tech talk takes, and I'll be hanging out below, figuratively of course, to catch all your thoughts. Let's geek out together as always. All right, folks, let's talk about Microsoft. With all the financial shenanigans on display, the question looms: buy, hold, or sell? Here's the scoop. Microsoft's PE and PB ratios are lower than the industry norms. Generally, that suggests it might be undervalued, making it an attractive buy for bargain hunters. Plus, it's got a whopping $38.23 billion in EBITDA, like finding a superhero stash of cash, reinforcing its robust financial health. The 16.4% revenue growth screams, we're setting the pace here. However, the return on equity is lagging, hinting at some internal inefficiencies. Despite this, their low debt-to-equity ratio of 0.21 radiates stability, perfect for those cautious investors wary of uncertain times. So drumroll, please. I'd lean towards on Microsoft, based on its solid financial standing, growth potential, and current undervaluation signals. But plot twist, always, and I mean always, do your own research. Dive into the numbers, consult your magical financial crystal ball, or even your financial advisor. Everyone's risk appetite and investment goals differ. In other words, don't just take my upbeat tech spiel or the market's mood swings at face value. Dive deeper, align it to your strategy, and let's keep chatting about those tech titans. Overall, today's tech market showcased a fascinating dance of numbers and strategic moves. Jamf Holding Corp dazzled with its enhanced partnerships and innovations. Apple stirred up buzz with high valuations and legal drama, all under Warren Buffett's careful watch. Paylocity experienced insider trading waves revealing intriguing insights into its future, and Microsoft added a dash of suspense with its mixed yet digestible financials, potentially offering a golden opportunity for investors. It's clear the tech industry is never short of exciting twists and turns. If you enjoyed today's sizzling review, don't forget to like, subscribe, and share the video. And be sure to tune in tomorrow for another dose of the hottest tech tidbits. Keep those tech talks buzzing, everyone.